What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is June 20th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we're going to be diving into the renowned strength we've been seeing in Bitcoin's price over the past 48 hours, as we've surged up about 16% from the lows here around 17,500 all the way up to 20,500. A major move, recovering back about 5 days of correction in Bitcoin's price. Now, as everyone just a couple days ago were calling for the collapse and the death of Bitcoin, the question on everyone's mind is whether or not we've officially set in a bottom. And all the while, I am a believer at this point, dollar cost averaging definitely makes sense. At the same time, we may not want to get too far ahead of ourselves. So we're going to be diving into this as we go throughout the video. If you guys enjoy the video, consider dropping a like and subscribing. It's one of the best ways you guys can support the channel and make sure you don't miss out on content here. Now, all the while here, I've got the hourly chart open. I want to bring this back to the daily chart, because I want to spend some time to talk about how we can really find capitulative low buying opportunities according to history for Bitcoin. Now, I first off want to just talk about the current situation that we've been through. The first thing here is if we take a look from the all-time high that we set here, what many people would call the peak of the bull market back in November of 2011, and the lows here that we saw just the other day, we've had nearly a 75% correction, right around that range, around 74.5%. And this already, again, as I emphasized before at the beginning of the video, is comfortable territory to dollar cost average. Slowly taking additional cash that you have on standby or income that you have that's disposable and slowly investing back into the market, okay? So I, again, wouldn't discourage that you wait around. If you want to start dollar cost averaging, fine by me. I think that's actually a great thing to do here. This is historically a range where you're getting Bitcoin at a good discount. No matter what the macro environment is telling you, no matter all the scare that's going on, all in all, this has generally been a good range to buy, not only Bitcoin, but especially other traditional asset classes. But at the same time, I want to spend some time to explain here why I don't want people to get too caught up in the excitement here. While I do feel we could see another day or so of gains here, maybe even coming back up to this range here from June of 2022, I want to emphasize the difference between where we are now, this 75% correction, and what an 80% correction might look like. One of the biggest difficulties that some people have is understanding how percentage declines can get exponentially worse, even though you're only moving down technically in the sense of percentage terms by a couple single-digit points. So for example, if we go from 75% to the typical 80% correction, what would that look like here? Well, it wouldn't just be a couple $100 or $1,000 down. No, we would be going from a $17,500 Bitcoin price all the way down here towards around 13,700. Testing towards that 14K range here that we saw price top out at, or at least set an interim top here during the bull market back in June of 2019. Some of you might be saying in this case, Nick, that can't happen. Again, you don't want to completely flip your tone. Are you going bearish? No, I'm not saying that I think this is absolutely going to happen. This is what I would generally call probably like the worst case scenario level here, the typical 80% correction of price. But the reason why I'm keeping open to that, and again, in a bit of humbleness here from some of my mistakes I made over the past couple months in my calls, I think an important thing to understand here is that while we're also conservative on understanding that as with each new bull market, we're going to get lower percentage returns as we did the previous time, it's just the concept of markets of scale, while I would usually expect that corrections grow weaker over time, and they have historically grown weaker, it's probably going to be that we get the typical 80% correction considering the macro environment we're in right now. So that's an important thing to keep open to here, to not absolutely go all in this case, but rather to dollar cost average over time and not try to pick absolute bottoms, and especially not try to pick a bottom with ridiculous levels of leverage. The reason I want to emphasize that so heavily here is I've been watching Bookmap here, one of our tools here that we use on the channel here to track the market. And as you guys know, we've covered here not only the historical heat map data here, the order book here, the combined order book for a lot of the liquid exchanges, so you can see where the bids, the asks are, where price support roughly hangs and how it travels over time with price, but also the liquidation tool here, the liquidation tracker that Bookmap has. And this has been showcasing here that people on both sides of the equation have been getting knocked out left and right. And it's been helping institutional traders to be able to trade throughout this volatility here. And it can help you guys as well to navigate it here, to find when capitulations might be over, both to the downside as longs get liquidated, but also to the upside as shorts get squeezed out of their positions. And it's so unfortunate here because already people have been hurt by the downturn here if you've been long and exposed to crypto. The second worst thing is trying to revenge trade and not having the market insights here as to where liquidations are happening, right? Where people, generally retail traders or emotional traders, are getting knocked out of their positions. So if you guys are interested again in emphasizing that market data, going beyond just price or technical indicators for that matter, I highly recommend you guys keep an eye on Bookmap. It's not only one of my favorite tools here, but on top of that as well, it gives you a lot of market insights you just simply can't get on other platforms. And I've been using it hands down as I've been tracking through this correction to see where price might go. So if you guys are interested, you can get a discount on your first month in the link down below in the description. But I highly recommend, if you guys are interested, just to at least try the free version here and give it a go. Now, coming back here to the chart, I want to go ahead and spend a little bit of time to focus in on the EMA, okay? Now, this is the exponential moving average with the 200 value here, okay? So essentially, if you guys don't know about moving averages, they're generally measures of where price has been over a certain period of time. So if we're looking at the daily chart and we have a normal moving average of 200, that's going to be the average closing price of the last 200 days. And why this metric is so important here, and although there is differences between the EMA and the SMA, the important thing here is that we can start to understand here where institutions might be looking to get into an asset. Now, on the daily chart here, you might notice here as well, we're very far away from the EMA here. And what I want to spend some time to talk about today is a really new interesting indicator that I found in the market that I think holds a lot of value here. The 200 EMA here essentially is a very important metric because it's not only where during bull markets buyers may come in either below the EMA or near the EMA, but on top of that as well, divergences from these moving averages where price is heavily above the EMA or below it, that can give us some telltale signs as to when price might be at a discount or overbought. Now, I want to take a little bit of time to look back at history here during prior corrections and bear markets. And what I think is very interesting here is if we just simply take a look at the spread from the moving average here, we've got a 200 value point here, we can see that where we are right now is very similar correction territory to the bottom of December 2018, right? And again, as I emphasized earlier, right, I'm not saying this is a foolproof method here and we should say that there's an absolute bottom, but we're probably getting very, very close to it. We may just hang below this range for a while or have a secondary retest towards this range, similar to how here in June 2018, we came to this level and rolled back over even lower here, meaning that as the EMA is coming down, probably price is also going to be at a lower level here, right? And we can see that here if we take a look here, excuse me, I was hitting the wrong keys, within price here, right? We saw that there was a much lower price point here. So again, I think that we are getting very, very close here to these capitulative lows. And on top of that, we can see here that throughout prior bull markets, and we can even take it to the 3-day here so we get a little bit more price history, right? If we take a look at the long-term statute of the spread from the MA, we can see here that in January 2015, when we set in the lows of that previous bear market, right, after a heavy 80 to 90% correction here, right, we came down to a very similar range here. And this is why when you take a look at the RSI and a lot of the market metrics out there, you'll see that Bitcoin's price is at some of the most oversold levels in history. And yes, that does have to do with the macro environment. It has to do with the amount of liquidations going on in the space, people over leverage, pushing price down, a lot of the loans getting liquidated on platforms like Celsius and BlockFi and Nexo that are causing market order flow, sell side pressure on price to exacerbate the correction even more. Only until to be stopped until enough buyers come in to take benefit of that sell side pressure, setting in the bids to provide support and fill their orders in order to drive price back up. So again, keeping that in mind here, we are in discount territory. The question remains though, do we have another leg down here before we really start to bottom out, as we typically do in a bear market, and have our capitulation sideways, right? We are really wanting to see something like this before we really start to get too excited about price. We want to see sideways capitulation, and we have yet to see that here. It's going to take time to formulate that here. I don't think we're going to get some exacerbated rally unless something changes on the macro stance, and that's really whether or not the Fed starts to reverse its policy decisions and drive liquidity back into the financial system. We have not seen that yet. So we have to track what the Fed is doing and what's going on with inflation. Now we'll dive into that topic of inflation and some of the market metrics that we have later on. But I want to go ahead and take a look here real quickly at ETH to BTC. ETH BTC has held here neutral to where it was back here in early June. If we take a look here on the daily chart, we can see that we've recouped here back about a week or more's worth of losses here, coming back up to where we were back on June 14th. And it looks like ETH avoided going into what's known as really kind of like the death zone here, essentially, right? There aren't many critical levels of support for Ethereum against Bitcoin until down here at 0.038 on the ratio, coming back to this point where we've had previous buyers coming back in the past, as well as it treating as previous resistance when price was below the range for a prolonged period of time. And look at that again right there, 200-week EMA buyers coming in here like they've done in the past. So again, this is a range here where we could see a little bit of rebound, maybe even come up here and retest 0.06 on the ratio. But I do believe, again, being a bit more conservative here, depending on how the ETH merge happens, we could see a rollover throughout this market back into that range, right? Again, I think short-term relief is here for a little while. Same with Bitcoin, right? As we talked about here, we could continue this and really get a nice solid green candle, maybe engulfing a lot of these losses here. But again, as we take a look back during previous cycle corrections, we have many weeks like this, right? We have these periods of time where people think the bottom is in and it rolls back over here. We can see that time and time again here in the past here. We had a capitulation candle here to 273. We rallied up to 478, and then we roll back over all the way down here to $166 and multiple little green candles in between, right? So just keep that in mind here, right? A lot of the corrections, again, can continue when people least expect them. Now, one thing I emphasized here, and I think we talked about on the channel, but I put out a tweet and it went pretty viral, one of my bigger tweets that I've had in some time on Twitter, was talking about how altcoins have been holding up phenomenally well here. And I think this is something that cannot go unnoticed here, because I know a lot of people are looking to just sell off a lot of their positions, get out of the market. And all the while, I think that that's understandable here. It's probably good to de-risk into some of the strength. What I do want to point out is just how interesting the divergence is between Bitcoin and Ethereum. And again, this brings up this point here of how there are a lot of powers within the financial space right now, and specifically in the crypto sector, that are essentially chasing liquidations here. A lot of the sell side pressure we saw here was exacerbated due to the fact here that there are a lot of leveraged players here in both Bitcoin and Ethereum that got knocked out and forced out of their positions. And there are still some remaining below here, hence why I think that we could see a rollover here in price. It's not guaranteed. But if we take a look here at basically total 2 minus ETH, USDC, and USDT, right? So we're taking out Ethereum, who are really trying to analyze the underlying altcoin market, everything but Ethereum and Bitcoin, as well as removing stablecoin liquidity. We see a really interesting trend here. We see here that against Bitcoin, and we divide and make a ratio effectively, we're back essentially to where they were against Bitcoin back here May 12th. This continuation, this continued downward trend from 30K to 20K here has been practically negligible here for altcoins. Now, in dollar terms, yes, it is dropped down essentially 33% on average like Bitcoin here. But what I find fascinating is that usually you would expect altcoins to break lower here. We should have broken downwards, similar to what we did in the past. But what I think we're seeing here, again, and I think why we have a couple more days of strength here, where again we've having this kind of relief rally, right? What we want to watch for here is a repeat of history. Do we have the correction downward, a dead cat bounce, and a continuation lower for altcoins, as we might be playing out here, right? That's kind of the worst case scenario. We come back down towards this kind of capitulation range where it's beneficial to buy altcoins, or are we going to be able to hold on here and start to move higher with the ETH merge, as well as the fact that altcoins are probably just going to be a larger portion of the market going forward in the future. I think this question is going to be answered as to whether or not the Federal Reserve is able to contain inflation sooner rather than later. Because if we are going through a decade of inflation like the 1970s, I got to be honest with you all. I've got altcoins. We're exposed to altcoins in our portfolio. If it turns out that the Fed cannot tame inflation, you are going to probably see this repeat history here and go downward most likely. Doesn't matter about the merge and the exciting things you can do on Ethereum. To be honest with you all, it's not going to be enough for investors. People are going to want to de-risk in that kind of environment. On the other hand here, if we do tame inflation, if the Federal Reserve is able to be aggressive, put the economy unfortunately into a temporary recession, and therefore cool down inflation, get commodity prices down, then from there, we could see altcoins hold at this range. And it's going to depend on how quick the Fed can react here and what the inflation numbers look like going into the summer. So keep an eye on this range here, this price range here around 0.5 on the ratio. And it's an important psychological level here, right? It's half, and essentially altcoins holding half of the market cap of Bitcoin here when we're really talking about the altcoin market separate from Ethereum and stablecoin liquidity. So I'm very interested to see how it's going to play out here. I definitely think it's one you're going to want to keep on your radar. You guys can build this ratio yourself. It's up here in the top left corner. It's total 2 minus ETH minus USDC minus USDT divided by BTC. But we will be keeping a track of it here on the channel. Not to mention as well, and this is, again, a great perspective on how percentage declines, all the while they might look lucrative, can also get progressively worse each single digit that we're moving down. So, for example, we've had a nice clean 80% correction. Pretty expected that some buyers would come in here. And again, we might get a little bit of a relief rally here. Maybe altcoin valuations come up here towards previous support here at around $300 billion. Gives us a great recovery back to where we were back here in mid-May. And then we roll back over here and we come back down towards $100 billion or $125 billion here sometime in the fall. Who knows exactly how it's going to play out here. But if we do get that kind of correction again, some people might say, oh, it's an 88% correction, right? That's only 10% worse, right? No, it's not. It's much, much worse from there. It's about a 50% haircut from where we are right now. So bear that in mind here when it comes to kind of setting in your targets. Not going all in, but starting to slowly dollar cost average. Because as you dollar cost average into the lows, you start to average your price down as price continues to go lower here. So your average entry will be somewhere in between that absolute bottom and where we are about right now. So again, if you want to start DCAing, I think it's fair territory here, but assume that it's likely going to continue lower. And the heavier price goes down, maybe you might want to invest heavier and heavier there when you DCA. Now, a lot of people are talking about whether or not Bitcoin has officially set a bottom. And again, I want to go ahead and talk about, I think, the key charts you need to watch here. And we've talked about them before on the channel that are going to answer this question. And it has to do with tracking things that have to do with the Fed's monetary policy and its ability to tame inflation. So what I think we need to watch here is a few key charts. We obviously are going to be keeping an eye on equity markets, which again are at a nice healthy discount. The NASDAQ is down 34% here. We're at the 200-week EMA here, right? We've started to see a big divergence from kind of the euphoric highs that we had here for the EMA coming down towards discount territory where buyers came in back here during March of 2020, right? And many times in the past. But at the same time, if we really do have a severe correction here, we've seen during past bear markets like the dot-com bubble, albeit we're not per se in a similar scenario as the dot-com bubble, or the housing crisis back in 2008, right? We do break below that 200-week. So it is important to not just use this as an end-all be-all for bottoms, even if we hold out here and rebound a little bit, right? It's an area where we can start to potentially build some positions here if we've got some cash. But again, I would hold some cash on the side here, see whether or not we can actually hold this like we did in the past. And second off here, I think we need to take a look at treasury yields. Treasury yields have cooled down here, at least for the 10-year, and I think a lot of the other yields across the 2-year and a lot of other treasury bills, we can see are going down from around 3.5 to 3.2%. And all the while, these candles here are signaling a little bit of worrisome movement here, right? We've been in a nice uptrend here, but it looks like we might be cooling down to wait to come down to one of these averages here. At the same time, it's still holding the trend here. until we really see a breakaway from the treasury yields that can signal that the market is calling the Fed's bluff on rising inflation as much as it's claiming it's going to, or excuse me, not inflation, interest rates in order to tame inflation. Then we are going to continue seeing these treasury yields continue to rise in anticipation for the Fed's rate hikes. And last but not least, take a look at oil here. This has got to be one of the most important charts you guys can be keeping an eye on. And on top of that, I think it's very, very interesting to see what's been going on here for the past week. For the week here of June 13th, we just wrapped it up here. We saw oil go down about 10.5% here, failing on the breakout here to reclaim new relative highs here that we hadn't seen since back here in 2008. From the previous commodities bubble, we saw a nice beat down here, about 10.5% down here. Now, again, this is what we've been looking for here to see whether or not the Fed will be able to actually keep interest rate hikes more moderate, because if commodity prices start to cool down and the Fed doesn't have to rise interest rates so much to cool down the demand, then we could start to see a lot less pressure on financial assets, essentially, because we're not having to raise rates, we're not having to engage in quantitative tightening so heavily, right? We already probably know that for the next preceding months, the Fed is going to meet towards what they're talking about. But it's continuously about, hey, what's going to happen 3 to 6 months out, right? What's going to happen each and every meeting going forward here that can help us to prepare and understanding how asset markets are going to perform. So I think this is a chart, again, you guys should keep on your radar here. If we take a look at the 2-week here, again, not as exciting as a lot of people were about commodities back a couple weeks ago. A lot of chop here, trying to see if we can turn this range of previous resistance in the past into support. And if we don't, if we break lower here and probably break below that $100 range here, that's probably your telltale sign that oil is ready to cool down here, that we are going to see a bit of commodity deflation here in regards to prices and start to see the Federal Reserve take a more mild tone rather than being incredibly hawkish, being much more laid back and less eager to raise interest rates. So these are the charts that we're watching here. Getting back to this question about Bitcoin bottoming, the case in point is simple here. DCA makes sense at this territory, but going all in, especially on leverage, could not only regard in a lot of losses here on a pretty good amount of cash that you might have, but on top of that as well, potentially losing it all, especially if you're toying with leverage. Stay away from it, guys. Trade smart, focus on the long term, have a long-term time frame horizon, and be patient. Let the market come to you. Let it give you that opportunity. It's one of the biggest things that I've learned here from this cycle that I did a much better job of in 2017. In hindsight, I always like to reflect on what I did good and what I did bad, because if I don't, then you'll never learn from the past. All right? And we're going to make sure we navigate the next cycle much better, taking better profits along the way, like we did when we took and closed out of all of our positions in altcoins back in the January altcoin rally at the Bitcoin peak, right? We got out 2 days before the altcoins peak. Did we miss some good days? Sure. But we didn't lose our arm and a leg months later as we were back in Bitcoin or cash, rather than those altcoin positions that then proceeded on to crash 80% or more. So anyways, guys, that's it for today's video. Thank you all so much for letting me ramble. If you enjoyed the video, please consider dropping a like and let me know what you think down below in the comments. If you agree with me or you disagree, let's get a conversation going, guys. That being said, have a wonderful rest of your day, and I'll see you all in the next one. Take care, everyone.